Good evening, everyone. Thanks for attending tonight's webinar, Riding the Reopening Wave with S-REIT Leaders through CSOP iEdge S-REIT Leaders Index ETF. My name is Bruce, Portfolio Manager at CSOP Asset Management in Singapore. I would also like to take this opportunity to thank Tiger Brokers to organize this webcast. And today's presentation will divide into three parts. I'll start with the most recent market outlook and highlight why S-REITs are still well positioned under current market environment. Then I'll discuss why our ETF uses the S-REIT Leaders Index as the benchmark, followed by why investors should consider CSOP S-REIT ETF to access the sector. So first of all, why S-REITs for now? We believe the S-REITs have attractive yield and can act a good inflation hedge under the current high inflation environment. And currently, investors continue to focus on macro headwinds, such as the Fed tightening, the potential slower global growth, and high inflation. For example, the recent 75 bips rate hike is the largest since 1994, and the US Fed wants to financial conditions to tighten, which is a negative for equities in general, including the S-REITs. And the dot plot for the Fed rates are now expecting the rates to reach 3.4% by this end of this year and 3.75% by next year. And in the meantime, the global growth is also expected to slow to as low as 2.9% only this year. And the sudden and sharp increase in rates, coupled with the continued war in Ukraine and COVID lockdown in China, are now raising the prospect of much slower growth or even slow down. Meanwhile, the inflation is steeper than expected. For example, the higher potential electricity costs will have negative impact on margins and even DPU growth for some REITs. But some REITs assets can pass through the higher inflation, can benefit from this trend. And typically, the retailers and subsequently retail rents will benefit from the higher inflation as retailers are able to adjust prices more rapidly. And within the S-REIT universe, the valuation looks a little bit stretched, which is mainly because of the sharp increase in terms of the 10-year bond yields. This has resulted in the yield spread falling to 2.6%, which is a -2 standard deviation below average. So it might be a little bit difficult for S-REITs to outperform in this environment. And also the higher interest rates will hurt the S-REIT's ability to make the yield accretive acquisitions because of the higher potential cap rate expansion. But we do believe, since there are still quite a few REIT names which could provide a very resilient dividend yield. So those higher yielding REITs will likely, like the industrial REITs, will still fare better due to the higher yield differential compared to the interest rates. And comparatively, there are still some micro tailwinds if we specifically refer to S-REITs. First of all, is that SGD assets could see some inflows from the family offices because Singapore recently introduces the new requirements for family offices based in Singapore. They must now invest in at least around 10% of their AUM or Sing$ 10 million, whichever is lower, in local investment, such as the listed equities on SGX. And the reopening of the economy is also well underway. For example, the offices are back to 70% occupancy, and retail malls are seeing foot traffic return to pre-COVID levels, and hotels are starting to see healthy RevPAR growth. And the defensive names such as industrial demand remains firm, and we expect all the real estate subsectors to see the positive rental growth in fiscal year 2022 and fiscal year 2023. And the travel boosting, particularly travel boosting the retail and hotels, For example, the monthly visitor arrivals have jumped with the relaxation of travel restrictions, with more than 400K visitors in May, and compared to only 27K last year. Though this is still below the pre-COVID level, this directional trend is very positive. And as compared to the higher the interest rate, we believe the GDP growth and changes in GDP growth have a stronger correlation to S-REIT's performance. And since the Singapore GDP is expected to grow nearly 4%, although this number is lower than 2021, which is 7.6%, but this growth rate is pretty much in line with the last period before COVID from 2011 to 2018. And we continue to expect the GDP growth to be positive in Singapore, and hence should be supportive of the S-REIT performance. This, we think S-REITs are still relatively well-positioned under the current market environment. I believe most of you are already familiar with REITs benefits such as liquidity, accessibility, and also the tax efficiency. So in the next couple of slides, I'll emphasize more on the strategic case for S-REITs specifically as compared to other REITs. And on page 8, as compared to traditional SG equities, bonds, as well as the money market instruments, S-REITs currently can still provide a decent yield pickup, as shown on the chart on the left. And when comparing the S-REITs versus its major global or regional equity and risk peers, the iEdge S-REIT Leaders Index, the benchmark used by our ETF, has the highest dividend yield with the lowest 90-day volatility, representing very strong return risk profile. And even investors argue for a higher inflation environment in Singapore, outside Singapore, say as high as 5% in Singapore this year. The most recent 5.6% yield of the S-REITs could still cover the inflation as S-REITs can raise the rent, because rent's also part of the CPI component to outperform the inflation. And comparatively, the US REITs are yielding around 3 to 4%, can hardly beat the US inflation, expected at nearly 8% this year. And S-REIT market also grew very rapidly over the past 11 years. And with annual growth rate at 11%, now S-REIT market has grown to SGD 111 billion as of end last year. And it is expected to attract more inflows, not only from Singapore, but also from ASEAN region, North Asia region, including China. And historically, the S-REIT also outperformed its major global peers over the past 6 years. For example, our S-REIT Leaders Index had an average annualized total return of 8% and a 90-day volatility of 11.9% over the comparable periods. And if we extend this performance period to over the past 10 years, our S-REIT Leaders Index had an annualized total return nearly 9%. And among these 9%, around half is from the underlying dividend payment, and the rest is from the capital gain and the reinvest of those dividends and their according subsequent capital gain. So in the next section, we'll mainly talk about why our ETF uses the SGX iEdge S-REIT Leaders Index. And page 13 is an index snapshot. I will not go through details, but just want to highlight the free float and the liquidity screening creates a highly investable universe with large and mid-cap S-REIT focus. And the implication here is that our investment universe can always capture the hot investment themes. And then shown on the pie chart on top right, currently, industrial and data center REITs accounts for around 45% as they act as defensive plays and tend to benefit from the structural tailwinds. And the reopening theme, such as office, retail, and hotel REITs, also have around 40% exposure. And as for geographical allocation, even the holdings are all S-REITs, the underlying projects do have APAC and global exposures so that investors can access international projects with S-REITs tax efficiency. The backtesting does show that the large and mid-cap S-REITs outperformed market greatly, as the scale advantage creates a positive spiral because it helps those S-REITs raise debt with a relatively low cost and acquire the properties in multiple channels, and thus create larger market cap, better liquidity, and higher valuations, which in turn help them raise more equity. And currently, around 70% of our ETF holdings have government-linked sponsors, which own quality, newer, well-located and dominant assets. And this helps them achieve operational efficiencies and great global outreach. And this in turn translates into potential yield advantage and lower funding costs. And liquidity advantage is another highlighted point, as the index tends to overweight S-REITs with better liquidity and underweight or remove those with poorer liquidity. The index always keep a relatively tradable universe, which finally leads to a better ETF liquidity. It's just as shown on page 17, and our ETF's beta spread, it's around at 38 bips. It's typically lower than the weighted average of the underlying S-REITs, which are traded around 57 bips on SGX. And if investors choose ETF's primary creation or redemption options like a mutual fund, the cost is also significantly lower than the direct trading those names on exchange. And diversification advantage can also not be overlooked. And now our investment universe includes both the defensive names and cyclical plays, so can provide some downside protection during market downturn and also capture the upside over the bull market. And the index volatility is also lower than all of its underlying REIT holdings, thanks to the diversification benefits, and its maximum drawdown is also lower than all of its largest 5 underlying holdings. So to quickly summarize the index investing benefit, first, it has a very strong performance over the past 5-6 years. And second, it has a liquidity adjustment strategy that follows the fund flows and capture the sector rotation. Third, it has a lower volatility compared to the individual S-REITs and other REIT indices. And fourth is it also has a lower index turnover, leads to a lower relatively rebalancing costs because it includes mainly includes the large and mid cap. And lastly, it has a weighting towards these large and mid cap names, so which could typically outperform the smaller REITs in the history. So in the last section, we'll discuss why using the CSOP S-REIT Leaders ETF to access the S-REIT sector. And on page 22, it's a snapshot of our ETF, the CSOP iEdge S-REIT Leaders Index ETF. Now the AUM is over SGD 70 million, and we expect to grow our AUM in the next couple of months. And our investment objective is to replicate the benchmark as closely as possible. And currently we have 2 trading counters on SGX. One is SRT, which is the SGD counter. It's mainly for the local investors. The other one is the USD counter SRU. This is not only for retail local investors, but also for global investors. And our base currency, of course, is SGD. And currently, we provide 2 trading options. One is the secondary market trading, both SGD and US dollar are accepted. And another trading option is the primary creation and redemption. Now SGD is only SGD is accepted. And on exchange, the board size is just 1 unit. So theoretically, investors can trade these ETFs starting from around or slightly below the 1 SGD. And in terms of the creation redemption size, it's also not quite high. It's just 50,000 units or around 50,000 SGD. And we will distribute our dividend on a semi-annual basis. But since we launched our ETF in November 2021, so the first time we will pay our dividend, it will be around at late July or early August. But this time we'll combine the dividend we received from November to December last year, and also the first half this year. So we will pay all we collect over this nearly this 8 months. So we will not retain any. So we will pay back all of them. And also these ETF, since we all invest in the underlying S-REITs, so it is classified as an EIP. And currently the management fee is only 50 bips. And the total TER is capped at 60 bips, which these 60 bips already includes the 50 bips management fee. So no matter what happens, we'll cap this up the total cost to up to 60 bips. And we also hire a investment advisor, JLP Asset Management, which is a property and REITs expert with presence in New York, London, as well as in Singapore. So investors can pay the passive ETF fees for the active service. In the next page is comparison between the investing in property individual S-REIT and the S-REIT ETF. I don't want to highlight more on the why S-REIT versus physical property, but want to spend more time on why S-REIT ETF versus the single individual S-REIT. I would say as compared to investing in a single REIT, the S-REIT ETF will invest in a basket of high-quality S-REITs with revenue exposure from various industries and regions. And in terms of the cost and entry threshold, if investors want to replicate a basket of ETF, they may need to at least spend SGD 4,000 plus to replicate the basket. But if you directly invest in the S-REIT ETF, the starting point is just around $1. And more importantly, even you investors can create this basket. The bid-ask spread can be way higher than you invest in the S-REIT ETF. And here, the difference can be as high as 20 or even 30, 40 bips. And from a diversification perspective, investing in individual S-REIT already have a higher diversification benefits versus individual physical property. But investing in S-REIT ETF can further enhance the diversification because it will invest in more than one S-REITs. And liquidity is also the highest as compared to physical property and individual S-REIT investing. And transparency is as high as compared to investing in S-REITs, so as to the tax efficiency. But more importantly is that through investing in a diversified basket, investors' dividend yield actually is more stable and sustainable. Currently, the S-REIT index universe, it is expected to deliver a yield at around 5.6%. But investing in single names, this range can be quite wide. And since we have more than 6 months of track record, and in this slide we'll show our performance summary since inception in November last year. And despite the outbreak of the Omicron and the Russian-Ukraine war and the Fed tightening, the ETF is quite relatively defensive and outperforming the US bonds, US tips, and even US equities, thanks to its relatively defensive positioning shown below. And on a relatively performance or tracking basis, our SRT did outperform the benchmark thanks to by 26 bips since inception, thanks to our ETF's tax efficiency and our active participation in corporate actions of the underlying S-REITs. For example, we can opportunistically take advantage of the rights offers provided by the underlying S-REITs, and we can participate in those rights issues with deep discount prices versus index price. So all these benefits will translate into the outperformance of versus the benchmark and benefit our investors. And on a forward-looking basis, we still believe, to echo our outlook at the very beginning, we believe it's still a good time to invest in S-REITs with the macroeconomic reopening. And the cyclical sectors, such as the retail, office, and hotel REITs, are benefiting from the current reopening in Singapore. And the first quarter results also reaffirm the positive view. There are some strong expansionary demand from the tech sector, which could likely to absorb the upcoming new buildings, and better than expected retail rental reversion also could benefit the retail REITs. And moreover, the hotel REITs could benefit from the faster recovery in global travel, and the near doubling of the utility expenses and aggressive increase in base rates may have proven to be punitive, but shorter weighted average length expiry portfolio with strong pricing power could still have the ability to offset cost pressure and sustain the DPU growth. And specifically by sectors, the offices in CBD areas are still favored, particularly after more employees return to office and more foreigners move their families and business to Singapore, for example, from Hong Kong or even from China. This which not only boosts residential rents, but also commercial raise rents. While some traditional industries exit, the wealth management or the tech firms enter. So this combined with the limited supply should support up to high single-digit positive rental reversions for the office rents this year. And retail REITs were already at or above 80% shopper traffic tenant sales versus the pre-COVID level, and up to 5% of rental reversion is expected thanks to the revenge spending and less rental rebate aimed easing of control and reopening of the borders. And spending is also gradually shifting from staycation to vocation, corporate traveling and medical tourists for the hotel REIT sector. And for industrial logistic or data center REITs, they do face some challenge of higher costs, but they still have their structural tailwinds of the new economy exposure, such as the in-case warehousing and last mile facilities and hyperscalers. They also act as the defensive plays if growth become uncertain again, if any, for example, next year. So overall, it's still positive on the different sectors of the S-REIT this year and next year. So the key takeaways are our large and mid-cap S-REIT focus could offer quality assets, government sponsor, and very efficient management. And economic of scale will create a more higher potential yield and lower potential cost. And the market is still growing, and our index design provides a lot of liquidity. And in terms of our ETF, we do provide the cost and tax efficiency thanks to our pure S-REIT exposure. And our liquid adjustment rebalancing will always help investors capture the hot investment themes from time to time. And currently, our index dividend yield is around 5.6%, still very attractive versus the current bond yield and inflation rate. And our diversification will also help investors diversify their investment risk across different countries and sectors as compared to directly investing in single REIT names. And this diversification also help investors achieve a stable asset value growth over time, and also provides a relatively low volatility and turnover and more tradable universe for investors to access the sector. So this is pretty much for my presentation for today. So here I leave the contact information. Please feel free to contact our sales through the phone calls and email addresses. And of course, you can also contact Tiger Brokers for any question or trading requirements for this ETF. So thank you.